We've had a lot of strong data out of the US recently. Markets continue to push higher. You've got to ask yourself, does the economy really need these rate cuts, or are we in a situation where good news is actually good news again?
Yeah, it's a great point, Paul. I mean, if you look at the Atlanta's GDP now, their estimate for fourth quarter GDP is 2.4% annualized. So that is a far cry of where the central bank normally is when they're feeling like it's in time for them to cut rates. You add that to the CPI uptick that we saw, we got 0.3% month over month for December that beat consensus, which is 0.2. And then we've got 3.4% annualized when the consensus was 3.2. So you had slight CPI tick up. We know that's mostly shelter costs. We understand that. But when you've got CPI ticking up, you've got 2.4% annualized GDP growth, inflation adjusted, and then you have, retail sales in December. Until you get some kind of massive economic weakness showing, it's going to be really hard for the Fed to be ahead of the rest of the world in cutting rates. And the market is starting to realize that. And that's why you saw bond yields tick up this past week, because Christopher Waller came out and said these are not the conditions under which the Fed normally loosens and stimulates the Fed funds rate at a lower rate.
Well, I guess we could imagine a scenario where the economy might need support, and that comes back to that AI question again. If it is, as you describe, and as many do, this is the fourth industrial revolution, you've got to expect a bit of creative destruction that goes along with that. Are there any parts of the economy that are particularly at risk, any stocks you're avoiding as well?
Well, unfortunately, this industrial revolution is the one that is going to change the face of human capital as we know it. There are so many people that think that this is just a blue-collar situation. You're just going to go into your fast food restaurant. It's going to be all robotized. But it is completely beyond that. Obviously, we're talking about drivers universally potentially losing positions. Blue-collar, yes. But we're also talking about, just ChatGPT, for example. We've already had lawyers in the United States submit briefs that have been completely generated by ChatGPT, this AI source. So when you have all of the data of the United States, all of the court cases into a singular database, and you say, hey, draft me in a brief pleading these arguments using these case laws, I mean, everything eventually will come down to, can it be robotized, systematized through AI more efficiently and effectively than human capital? And so this is the shifting of human working as we know it. And of course, every industry will be impacted by that.
Something else that can impact every industry is just black swan events. I mean, COVID, of course, being the most recent. But when you're in a situation where you've got two wars that are underfoot, you've got a host of elections over the course of this year, including the US, of course, tensions between China and Washington. What geopolitical risk is standing out most to you, and how much are you pricing as well for any sort of unknowns?
Great question, Annabelle. So I would say obviously that we are certainly concerned about the Middle East and the geopolitical risk there, especially getting shipments through that area, any kind of additional stress in that area, additional escalation. The United States administration just reclassified the Houthis in that Middle East area as terrorists again, so that military intervention could actually begin on the U.S. side to protect whatever needs to be protected there. But you've got that situation. You still have Ukraine, Russia not resolved. You have potentially a Taiwan-Chinese escalation sometime this year. And so we have all of these things happening in the middle of a presidential election year. It's a lot. Investors should expect a bumpy year.